Welcome to our channel. Today, we're diving into the fascinating world of cryptocurrency. Whether you're a seasoned investor or just curious about digital currencies, this video is for you. We'll be breaking down some of the key concepts behind crypto, from how it works to its potential benefits and risks. Think of this video as your one-stop shop for understanding what all the hype is about. By the end of this video, you'll have a solid foundation in cryptocurrency basics, empowering you to navigate this exciting new asset class. So, buckle up and let's get started. Let's kick things off with one of the most fundamental concepts in cryptocurrency decentralization. This concept is the backbone of the entire cryptocurrency ecosystem and is what sets it apart from traditional financial systems. Now, when we talk about traditional currencies like the US dollar, they're controlled by a central authority, typically a government or central bank. These institutions have the power to influence the economy by making decisions that affect the currency's value. This central authority gets to decide things like how much money is printed, interest rates, and the overall value of the currency. They have a significant influence on the financial stability and economic policies of a country. But with cryptocurrency, it's a whole different ballgame. The rules are rewritten, and the power dynamics shift dramatically. Cryptocurrencies like Bitcoin operate on something called a blockchain, which is essentially a public digital ledger that records all transactions. This ledger is transparent and accessible to anyone, ensuring that every transaction is verifiable. This ledger isn't controlled by any single entity. Instead, it's distributed across a network of computers all over the world. This distribution ensures that no single point of failure can compromise the system. That means no single government, institution, or individual has control over the currency. The power is spread out, making it more resilient and less susceptible to manipulation. It's truly in the hands of the people, which is a huge draw for many cryptocurrency enthusiasts. They see it as a way to reclaim financial sovereignty and participate in a global financial system without intermediaries. Think of it like this. Imagine if you had a say in how the US dollar was managed. You could influence decisions that impact your financial future directly. That's the kind of power decentralization offers. It democratizes finance, giving everyone a voice and a stake in the system. It's about transparency, security, and taking control of your finances. Every transaction is recorded and visible, reducing the risk of fraud and corruption. But as with anything, there are always two sides to the coin. While decentralization offers many benefits, it also introduces new complexities and challenges. While decentralization offers incredible potential, it also comes with challenges. For instance, the lack of a central authority means that resolving disputes or addressing issues can be more complicated. For example, if something goes wrong, there's no central authority to turn to for help. Users must rely on the community and their own knowledge to navigate problems. It's up to the community to come together and find solutions. This can foster a strong sense of collaboration and innovation, but it also requires a high level of engagement and responsibility from users. So, while decentralization is a key pillar of cryptocurrency, it's essential to understand both its advantages and disadvantages. By weighing these factors, individuals can make informed decisions about their participation in the cryptocurrency ecosystem. Now, let's dive deeper into the technology that makes all of this possible: blockchain. This revolutionary technology is the foundation upon which the entire cryptocurrency ecosystem is built. As we mentioned earlier, a blockchain is essentially a digital ledger that records all cryptocurrency transactions. This ledger is decentralized and distributed across a network of computers, ensuring that no single entity has control over the entire network. Think of it like a giant public spreadsheet that everyone on the network has access to. This means that every participant in the network can see and verify the transactions, adding a layer of transparency and trust. Every time someone sends or receives cryptocurrency, that transaction is recorded on the blockchain. This process is automated and happens almost instantaneously, ensuring that the transaction history is always up to date. But here's where it gets really interesting. Each block of transactions is linked to the block before it, creating a chronological chain of all transactions ever made. This chain of blocks is what gives blockchain its name and its unique structure. And because this blockchain is distributed across a network of computers, it's incredibly secure. The decentralized nature of the network means that there is no single point of failure, making it highly resilient to attacks. Let's say someone wanted to tamper with a transaction. They would have to hack into not just one computer, but a majority of the computers on the network, which is practically impossible. This high level of security is one of the key reasons why blockchain is so trusted. This distributed nature of the blockchain is what makes it so secure and transparent. Every transaction is visible to all participants, making it nearly impossible to commit fraud or manipulate the system without being detected. Anyone can view the transaction history on the blockchain, making it incredibly difficult to commit fraud or manipulate the system. This transparency is a fundamental aspect of blockchain technology, fostering trust among users. Now, blockchain technology isn't just limited to cryptocurrency. Its potential applications extend far beyond digital currencies, offering innovative solutions in various fields. It has the potential to revolutionize a wide range of industries, from supply chain management to healthcare. By providing a secure and transparent way to track and manage data, blockchain can enhance efficiency and trust in these sectors. But at its core, blockchain is the backbone of cryptocurrency, providing a secure and transparent way to track and manage transactions. This foundational technology is what enables the entire crypto ecosystem to function smoothly and reliably. One of the most talked about aspects of cryptocurrency is anonymity. Now, it's important to note that not all cryptocurrencies offer the same level of anonymity. Some, like Bitcoin, are pseudonymous, meaning your transactions are linked to a unique address, but not necessarily your real-world identity. However, there are other cryptocurrencies known as privacy coins that are specifically designed to enhance anonymity. These coins use advanced cryptography to obscure transaction details, making it extremely difficult to trace the sender, receiver, or amount of cryptocurrency being sent. This focus on privacy has made cryptocurrency particularly popular in countries with strict capital controls or limited access to traditional financial services. It allows individuals to take control of their finances and transact without government surveillance or interference. But, as with any technology, there are potential downsides. The anonymity of cryptocurrency has also made it attractive for illicit activities, such as money laundering or purchasing illegal goods on the dark web. This has led to increased scrutiny from regulators and law enforcement agencies around the world. So, while anonymity can be a powerful tool for privacy, it's essential to be aware of the potential risks and use cryptocurrency responsibly. Let's talk about another key characteristic of many cryptocurrencies. Limited supply. This is a crucial aspect that sets them apart from traditional forms of money. Unlike traditional currencies, which can be printed endlessly by governments, many cryptocurrencies have a fixed supply cap. This means that there is a predetermined limit to how many units of the cryptocurrency can ever exist. Bitcoin, for example, has a maximum supply of 21 million coins. This cap is hard-coded into its protocol, ensuring that no more than this amount will ever be in circulation. That means once all 21 million bitcoins are mined, there will never be any more Bitcoin in circulation. This scarcity is a fundamental feature that can influence its market value. This limited supply is one of the factors that can contribute to Bitcoin's value. As demand increases and supply remains constant, the price can rise. Think about it like this. If you have a limited edition item like a rare baseball card or a vintage car, its value tends to increase over time because there's a finite supply. The rarity makes it more desirable. The same principle can apply to cryptocurrencies with a fixed supply. The limited availability can make them more attractive to investors. Now, it's important to note that not all cryptocurrencies have a limited supply. Some are designed to have an infinite or flexible supply. Some, like Ethereum, have a theoretically unlimited supply, although the rate at which new coins are created is controlled. This means that while new coins can be continuously produced, the process is regulated to prevent excessive inflation. But for those cryptocurrencies with a fixed supply, this scarcity can be a major draw for investors looking to hedge against inflation. The limited number of coins can act as a safeguard against the devaluation of money. When governments print more money, the value of traditional currencies can decrease. This is because the increased supply of money can lead to inflation, reducing purchasing power. But with a limited supply, cryptocurrencies like Bitcoin can potentially hold their value or even appreciate over time. This makes them an appealing option for those looking to protect their wealth from inflationary pressures. One of the most exciting aspects of cryptocurrency is its global accessibility. Unlike traditional financial systems, which can be slow, expensive, and restricted by geographical boundaries, cryptocurrency can be sent and received anywhere in the world with an internet connection. This has the potential to revolutionize the way we think about money and financial services. Imagine being able to send money to your family overseas instantly, without having to pay exorbitant fees or navigate complex banking regulations. Cryptocurrency makes this a reality. It empowers individuals, especially those in developing countries with limited access to traditional banking, to participate in the global economy. This borderless nature of cryptocurrency is also attracting attention from businesses and entrepreneurs. It allows them to conduct cross-border transactions more efficiently and reach new markets that were previously inaccessible. Of course, there are still challenges to overcome, such as regulatory uncertainty and the need for wider adoption. But the potential for cryptocurrency to break down financial barriers and create a more inclusive global economy is undeniable. Thanks for watching. We've covered a lot of ground today, from the basics of decentralization and blockchain technology to the potential benefits and risks of cryptocurrency. Hopefully, you now have a better understanding of what cryptocurrency is all about and how it works. Remember, this is just the tip of the iceberg. The world of cryptocurrency is constantly evolving, with new developments and innovations happening all the time. So stay curious, do your own research, and never stop learning. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more updates on the latest in finance and technology.